Hello everyone, my name is Huan Zi. I'm a Manager of Dealing and Investor Education at Phillip Investor Centre. Today we will explore how artificial intelligence, AI, and broader technological exposure can play a role in investors' portfolio, particularly through ETFs. AI have evolved tremendously, moving from hype into essential economic infrastructure. AI is no longer speculative, it is embedded across industries, driving infrastructure demand and reshaping global competition. The key question is not whether AI will grow, but how we should gain exposure prudently. Since the launch of generative AI platforms in late 2022, AI has transitioned from excitement and experimentation into enterprise-wide adoption. Companies are no longer simply testing AI tools, they're embedding them into core business operations. AI now powers diagnostics in healthcare, fraud detection in finance, automation in manufacturing, and personalization in retail. Unlike previous technological cycles that focus mainly on productivity software, AI represents the integration of intelligence into systems. In that sense, it is comparable to the adoption of electricity or the internet, foundational technologies that transform entire economies. There are three structural drivers supporting AI as a long-term megatrend. First, adoption is cross-industry. AI is not limited to technology firms. It is being deployed in healthcare for drug discovery, in finance for algorithmic trading and risk modeling, and in retail for advanced consumer analytics. Second, AI requires massive infrastructure investment. Training and deploying AI models demand advanced semiconductors, cloud infrastructure, and significant power capacity. Third, AI development is global. The US leads in software and chip design, China is advancing in applied AI and robotics, while Taiwan, South Korea, and Japan play critical roles in semiconductor manufacturing. This global participation expands the opportunity set for investors seeking diversified exposure. Every AI model requires computing power. This drives demand for advanced semiconductors, high bandwidth memory, and cloud infrastructure. AI models rely on advanced GPU and high bandwidth memory supporting demand for semiconductor designers such as NVIDIA and manufacturing leaders like Taiwan Semiconductor Manufacturing Company, TSMC. Regardless of which specific AI application ultimately prevails, the underlying need for computing power, memory, and cloud capacity remain fundamental. For this reason, infrastructure exposure often provides a more durable and foundational investment thesis within the broader AI team. While individual AI stocks have delivered significant returns, selecting long-term winners carries substantial risk. Technology evolves rapidly, and competitive advantage can shift quickly. AI ETFs address this challenge by providing diversified exposure across dozens of companies involved in various parts of the AI value chain. This reduces company-specific risk and mitigates the impact of technological obsolescence or execution missteps. Additionally, ETFs offer professional or rules-based portfolio management, transparent pricing throughout the trading day, liquidity comparable to stocks, and cost efficiency. For retail investors, ETFs simplify participation in a complex and rapidly evolving ecosystem. AI ETFs generally fall into three categories. The first category is semiconductor-focused ETFs. These funds provide concentrated exposure to chip designers and manufacturers that powers AI workloads. The second category comprises broad AI technology ETFs. These funds capture companies involved in AI software platforms and cloud services. The third category focuses on robotics and applied automation, investing in companies that implement AI across industrial, healthcare, and logistics applications. Each category offers distinct risk-return characteristics and can play different roles within a diversified portfolio. Despite its strong growth prospects, AI investing carries risks. Valuation in certain AI-related companies remain elevated, increasing sensitivity to earnings disappointment or macroeconomic shifts. Gains have also been concentrated in a small number of mega-cap stocks, creating concentration risk within some ETFs. Geopolitical tensions, particularly within semiconductor supply chains, may introduce volatility. In addition, regulatory oversight surrounding AI, data usage, and market dominance could impact certain companies. For these reasons, AI exposure should be incorporated as part of a broader, diversified investment strategy rather than a standalone allocation. In conclusion, AI represents a structural technological transformation with multi-year growth potential. Infrastructure demand remains foundational to the ecosystem. ETFs provide efficient and diversified access to this theme while mitigating single stock risk. However, disciplined allocation and risk management remain essential. By maintaining a long-term perspective and balancing exposure across infrastructure, software, and applied AI segments, investors can position their portfolio to participate in one of the most significant technological shifts of this generation. That's all for this episode of PhillipCapital Market Watch. If you found this video helpful, don't forget to like, subscribe, and stay tuned for more episodes. Thank you for joining us and see you next time.